This is the Tim and a Contrarian podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, nononsenseforex.com, and podcast players everywhere. Episode 189 is brought to us by Bybit. Not too much movement in the crypto markets this past week, but that's okay because as I said last week during the ad read, you can just park your tether, your unused tether, on Bybit's yielding platform while you wait and earn over 10% in the meantime. As we're about to learn this episode, and as we've been learning, yield is a really big deal, and it adds up, and it compounds. And what a luxury it is to be able to earn that much on money you just simply haven't deployed yet. This is on top of all the things that Bybit already gives you. What you need to do is go down to the description, click on the link to the Bybit blog. It keeps you up to date on everything that's going on. Then you click my affiliate link at the very bottom of that blog and get yourself signed up and get making money even when you're not trading. Because with Bybit, membership has its rewards. It is the Tim and a Contrarian podcast, and if you are a fan of the Dividend Series that we've had on here recently, this is going to be another one of those episodes. What I think I might do is on YouTube, at least, probably the easiest way, is just select the episodes that apply and make a separate playlist called the Dividend Series. Because this is a really big deal. It's been very well received. Thank you all very much. Because you guys understand, this isn't really the asymmetrical investing we normally talk about on the show, but it's pretty damn great. And everybody should be doing this in some capacity. Now, I know the title of this episode was a bit clickbaity, so if you read the title and you are some random fuckboy that just wants to get rich, listen to the next couple minutes here. I recommend you listen to the whole thing, but the next 2 minutes are going to be the big payoff for you. And then you can log off and do, whatever it is you people do. So the get rich part, as you know, there is no get rich quick in real life, not on this channel for sure. But what I think would be a great idea is we have already had people learn the no-nonsense Forex way of trading and parlay that into actual jobs. We have people who are working on trading desks right now, and that's mostly for stocks. But did you know, in the United States in particular, the bond market is bigger than the stock market? And I will bet your competition is almost non-existent compared to the world of stocks. So if you got really good at bond trading and were able to prove it, I would bet you'd be in real high demand. And if for some reason nobody out there would hire you, I bet you could probably break off on your own and start a paid service. And you would have, I don't know how big your audience would be, that's up to you. But most of your audience would be pensioners or people getting there, and they all have money. That's an audience most people would kill for. People think bonds are boring, and they generally are compared to most other financial instruments. But that's exactly why people sleep on them. And that's why I think this is still such a wide open space. So if you don't make a move in the paid space, I just might. I've never had a paid service before, but I'm not against it. But I've always said before on this show, I don't talk much about bonds because I don't know much about bonds. But that's only percentage-wise. Because if you know anything about bonds, they are a vast, deep space with so many routes you can take. And I'm just somebody who, unless I'm like 95% of the way there, which would officially put me in expert territory, I don't feel good talking about it. And if I'm not a legitimate expert on something, I'm not going to broadcast that lack of knowledge to thousands of people every week. But I do know what I need to know as far as the bond market goes, as far as how I roll personally. And I think there's a real opportunity here, in particular because there's a legitimate complaint that dividend investors could bring to the table right now, especially if you're doing it the way we do it with the monthly chart. And we'll talk about that later in the show. But let me go ahead and talk about the experience that I've had with bonds and the instruments I'm currently using. And I think for most of us, this is probably really all you have to know right now, too. I mean, you can go deeper if you want. Trust me, there's room. This ocean is wide and deep. But let me tell you my experience with the bond world, and then this will transition into the more actionable part. You'll see where this is going. So around 2023, I decided to really start prioritizing yield. There's all this free money that you can just have if you want it, or you can decide not to have it. And I was like, well, I'm not going to be stupid anymore. I'm going to decide to take the money, especially if the risk is very small. And so really this came full circle in an episode called FYPM on this podcast. And I think it is the one episode I probably back reference more than anything because it's so important, and I don't think most of you do it, and it's ridiculous not to. Because even though this yield may not seem like a big deal to you individually, when you start doing it all the time, it gets a lot bigger, and then it compounds. And I was tired of being left behind. So I have two main bank accounts, one in the United States, one offshore. I do have others, but they're just for specific purposes. I have two that I mainly use, right? And the domestic one is Chase. You guys know that. I've mentioned it before. And with them, I have a couple businesses connected to this account. This is where all my trading and investment profits go. And over time, my account got big enough to where they offered me something called Premier Banking. Now, this is not private banking. That's totally different. I think with Chase, you got to go through JP Morgan, and that's like $10 million just to get in the door. But Premier Banking opens the door to some other options, and you also get your own personal contact, which I thought was great. And I came to him one day and said, okay, so I understand for this account, I have to keep X amount in my bank account as a minimum. And if it drops below that, then I'm no longer eligible for Premier Banking. So I have to keep that money in there, and I can't really touch it. But my question is, does it matter what type of form this money takes? Does it have to just sit there in cash, or can I actually put it to work? And he's like, you can absolutely put it to work, and you probably should. I'm like, well, goddamn, that money's been sitting there for years, and I haven't done anything to make it grow, and I could have been doing that this whole time and gotten the compounding started. So I told him I was interested, but to make matters worse, it's a business account, and they have this rule where if it's a business account, you can't just go and do your own thing on their brokerage platform for some reason. You must have an advisor attached to you, which just in my brain, that means, oh, okay, so they want to extract as many fees as they possibly can from me. Not happening. We are not going to get along. But turns out we actually do get along. She's very nice. She's not the type to push products on you. She knows my stance on structured products. They're only good for people who have absolutely no idea what they're doing. But at the same time, you have to understand, if you're at the level of Premier Banking or private banking, it's different than just being a regular customer. The reason they brought you up to this level is because they want you to make money, but they want to be able to make money too. They don't want you just parking your money there and doing nothing. Now, I told her Chase already makes a ton of money off me due to their credit cards because that's almost all I use these days. But all I really want to do with this money is to put it in a type of bond category called a money market fund. And really all a money market fund does is allow you to take advantage of the interest rate on whatever currency you're using. In this case, it was the dollar. But unlike T-bills and things like that, you can actually go in and buy and sell these whenever you want. You have that extra agility. So you might get a little bit less yield, but you have the peace of mind of being able to come in and sell or sell a little bit or buy, whatever, whenever you want it to. And agility is paramount for me. So that's what I did. Now there's some pretty low-cost mutual funds out there for you to buy, and that's what I suggest you do. But again, I said before, having a good relationship with your bank, even if they're trying to extort fees from you, is still necessary. So I bit the bullet and I bought the JP Morgan money market fund, which has an absolutely rapey expense ratio. But I'm getting yield to where I wasn't getting anything before. I can have a good relationship with this bank and show them that I'm serious and I'm not a waste of their time. And you know what? That's worth it. Again, I was making zero before. Now I'm making something great. But you better bet I went to my other bank and said, hey, can I do this? Can I buy a money market fund and get some yield on the USD I'm holding here? And they said, absolutely. You go right ahead. And here's where I bought a cheap one. I think I just bought the Vanguard one. I still have it. And I've been earning yield on that ever since too. And fast forward to this past week, I'm like, oh crap. I have a Schwab account to where I do all my my stock trading. And I'll bet I have some dry powder there that I just never deployed. And I could probably get some yield on that too. Now, so I go there. I'm like, all right, I'm going to just buy a money market fund here. Problem is, Schwab's weird. Because it's a business account, I was not able to have a money market fund. So I looked for alternatives because I knew they existed, and they exist in the forms of ETFs. They're called bond fund ETFs, and they are pretty great. And that's the vehicle we will be talking about later in this episode. So what I did is, I might as well earn some brownie points with Schwab. I took their bond fund, ticker symbol SCHO, 3 basis points, ridiculous cheap. And now I got that machine running as well, alongside the other two. Also alongside the yield I'm getting on my Tether. I take half my Tether and I put it into Aave version 3 and I get yield there. And again, on the surface, what that's giving you every month, you probably can't live off of it. But again, if you just sit there and keep doing it and let it compound, it's going to become a lot more over time. It's the point I keep trying to get across. So the 2 points I've made on this show so far on this episode is to maybe get really good at bonds and then sell your services to either a company or direct to consumer. Probably a good idea because bonds are a big deal and have a really big audience with money. And then the other point, just remember, not financial advice, never is. I'm just a guy with a podcast, but it just makes perfect sense to take the majority of the money you have sitting in the bank right now and put it into something that gets you yield. In particular, something you can liquidate right away if you had to. I always tell people are always really weird about investing because they think they buy something and then that money's like not there anymore. Like you bought a bucket of chicken for $20 and now that $20 is gone. No, you're just taking whatever that money is and moving it from point A to point B. And you can always move all of it or some of it back from point B to point A if you ever needed to. There's very little to be afraid of here. So aside from the money you have in your account that you need this month to pay rent, pay mortgage, pay bills, take the rest of it and put it to work. You can do this in almost any country you're in with the developed market. They all have products for you. And if they don't, there's always the blockchain. Have we learned in the DeFi world from our previous mistakes? I would hope so. And even if that scares you, there is the CeFi way. It's not completely risk-free either, but you can get yield from centralized exchanges like Bybit or Coinbase or anywhere. It's a wonderful world with great opportunities should you choose to take them. And little by little, it does add up. I'm telling you right now, if you have been trading dividend stocks or paper trading them and tracking your portfolio, you see exactly what I'm talking about. I'm doing a big paper trade portfolio right now, and I'm because it's not my real money, I'm playing around with some things. Like I took a particular CEF that Seeking Alpha absolutely hated. I'm like, ooh, let's paper buy it and just see what happens. And it turned out that Seeking Alpha was right, and it absolutely ate shit. But because of the dividend I was earning on it, and it pays a monthly dividend, I was almost break even on it. And you can see on your portfolio too, if you use Yahoo Finance like I do, I have some of these positions that are down in price, but I'm actually up overall because of the dividends. Like these things really make a difference, man. Don't ever think they don't. But back to the point I brought up at the very top of the show. If you're a dividend investor or a budding dividend investor, and you're doing it the way we do it here by using the monthly chart, which I think is just an elite way of doing it. You might be a bit bored right now. There might not be a lot of opportunity because you might not be getting a whole lot of signals anywhere because some of these are either going down or they just keep going up, which means you don't get a signal. Now, what if you've been investing in dividend stocks and funds and CEFs for a while and you end up with a lot of dry powder but nowhere to put it because nothing is giving you a signal? Well, for one, you should probably have that dry powder in a fund earning yield. But if you actually want to deploy it, allow me to offer you a really interesting alternative, and a good one too. The big difference between money market funds and bond fund ETFs is one moves and one doesn't. Money market funds don't move. The price stays the same. Bond funds will actually move, which means you can chart them. And you're looking at yield right now with the United States dollar anywhere from the high 3s to the low 5s, depending on what it is. Now you might be saying, well, VP, thank you for the added asset class to trade, but I'm not seeing any signals there either. Well, you may not need one. Again, not financial advice, but the reason why these things move up and down in price has almost everything to do with interest rates. And they are inversely correlated. So when interest rates go up, the price of these things drop. But when interest rates drop, class, what cycle are we in right now? A hiking cycle or a cutting cycle? We are in a cutting cycle. I know Powell just came on and decided to keep interest rates where they were, but if you had to choose between hiking or cutting, it's pretty obvious we're in a cutting cycle. And Trump was very vehement about wanting rates to go lower. So there is an above average chance, to say the least, that the price of these things are going to go up, because interest rates, if they go anywhere, are likely to fall. So you could hypothetically, again, not financial advice, just buy them now and start enjoying those dividends. Because I'll tell you too, a lot of them don't move in a very wide band. For example, the one I bought in my Schwab account, SCHO, barely moves. It moves at most between $24 and $26. But that's what I want for that purpose. I'm not trading it, I'm holding it. And you have to be a bit careful with these. If you really want to trade them and get a decent amount of money out of them, look for ones that actually move in a wider band. With these, we can actually make some decent money and have the advantage of being pretty sure we know where rates are likely going to go. This is an added advantage you don't really have anywhere else. And don't forget, these pay dividends, and pretty darn good ones. There may come a time where interest rates bottom out and these things become less attractive, and that's fine. But we're not there right now. And oh, by the way, if we have a recession, and if it just so happens to be a big one, or a prolonged one, or even if it's neither one of those things and we just have a correction in the market, you're going to be really, really happy this weapon is now in your arsenal. And again, every developed market should have these. All throughout Europe, definitely the UK with your gilts, Australia. But what I'm going to do for the remainder of this show is I am going to kind of walk you through, it's an audio podcast, unfortunately, but what I want you to do is, if you're in front of your computer, if you're on your phone, this is going to be tough. Maybe finish out this episode, go home, and then fast forward to this point here. Maybe start like the 17.5-minute mark, and you'll see what I'm talking about. So know that in this environment right now, your shorter-term bonds are giving you more yield than your longer-term ones are. I mean, like your 30 years like in the high twos, and that's fine. That's not terrible. But there's higher ones available, so just take those, right? And you're going to want to find a bond fund that actually moves and correlates pretty well to what we've seen happen to rates in the past 10, 20 years. So a good one, in my opinion, is a ticker symbol LQD. If you pull that up on a chart, and you also take that little handy-dandy Fed funds rate chart that we like to look at here on the show. If you don't know what I'm talking about, just type in St. Louis Fed interest rate chart, and it should be the very first heading on Google, and you will see exactly what I'm talking about. When we had that big rise in interest rates, LQD ate shit. And then when we had that period where it just kind of flattened and we didn't raise or lower rates for a long time, it ranged. But if you go back a little further and look on your Fed chart to the period of time where we did nothing but cut rates, you can see that that's when LQD really had its time. And there's no reason to believe that's not going to be the case this time. I will say the one risk you might have is if Powell does something crazy and interrupts this whole nice, smooth cycle that we've been going through and decides to raise rates. I think the only reason he would ever do this is if we start to have inflation again. Now, I listen to a lot of macro guys. It's pretty split. There's some people that say all roads lead to inflation. There's people that say we're actually headed towards deflation. There's other people that say we're headed towards stagflation. Who the hell knows? But the one real risk to these funds, if you decide to go long, whether it's now or when your chart tells you to, is the possibility that that could happen. But the cool thing is, a lot of these bond funds, they operate in a narrow enough range to where if you really eat it, you're not going to eat it that bad. It's not going to go to zero. It's not going to lose 50% of its value overnight. Why? Because they're bonds. We get the benefits of extra downside protection because of what the instrument is, and then extra upside potential by knowing that these things pretty much follow rate hikes and rate cuts, and we have a reasonably good idea of what's coming up next. Oh, and here's what's cool too. You can also short these. There should be plenty of instruments out there available to allow you to short bond funds as well as go long. One caution I would give you on those is, I almost never say this, I'm usually very much against these, but you might want to go with the leveraged varieties if you're going to do this, because the non-leveraged ones, I don't think there's a lot of money in them because the expense ratios are high, because remember, in ETFs you always pay for creativity, but the short ones don't move a lot. You might need something leveraged there. But the good news is you do have options to do that. It's not like dividend stocks and funds and CEFs to where we can only go long. You can easily go short on these things too. If we're in a rate hiking cycle and it's obvious, yeah, short these things. Pays a dividend too, at a pretty nice one. So why wouldn't you? It's a wonderful world out there, contrarians, in the finance world. We have so many options out there, and so many of them we just didn't know about for the longest time. And if you were unaware of these options, whether you utilize these options or not, I'm just glad that you're aware of them now, especially when they're on the low end of the risk curve as well. Because even though we love asymmetry, we are also stewards of our downside, and that's why we win. And if you want to pay it forward and tell your friends about this, go right ahead. You're probably not going to get the best response back, though. They're probably going to say, "Are you crazy? With all the crypto gains and all this upside in the stock market, you're going to go to money market funds and bonds? What the hell are you doing?" And the appropriate response to them is, of course, that you are not crazy, that you're just early.